You've always been told that buying a home is the ultimate achievement, the physical brick and shingles fenced-in backyard embodiment of the American dream. Yet, only about 1/3 of millennials between the ages of 25 and 34 actually own houses, and of those who do, 63% reportedly regret their home purchase, with a quarter citing unexpected maintenance or hidden costs as the top reason. In more than half of US housing markets, in fact, it's actually cheaper to rent than to buy. So what's the deal? Is it worth plunking down your savings on a piece of property? Or is it wiser to keep renting for a period of time or until the end of time? The short truth, if you're able to afford the down payment on a home that's likely to appreciate, and you plan on hanging onto the property for at least 5 years, you should go for it. The long answer is everything I'm just about to talk about. Hello, my name is Max Monahan. I'm a real estate agent in Portland, Oregon, and let's get right into whether or not you should rent or buy a property. Before that though, please be sure to like the video if you're enjoying it so far, it does really mean a lot. And definitely be sure to subscribe as well if you enjoy personal finance and real estate related content. Anyway, let's get to it. Let's run the numbers. The most important first step in the rent/buy decision is, of course, determining whether or not you can afford to buy a home, and if so, if you can afford as much of a home as you need. Before going any further, let's look at the following numbers. Number 1, your emergency savings. You should only consider purchasing a home if you already have 3 to 6 months worth of expenses saved in an emergency fund. Having an emergency cash reserved in a high yield savings account is one of the most fundamental building blocks of good financial health, and it should come before any other investments, including buying property. Number 2 is looking at the down payment. Although you can purchase a home with a down payment that's as little as 3% of the purchase price in some cases, especially if you're a first-time home buyer, doing so means taking on more debt. Unless there's an incredibly compelling reason to take the plunge before you have a 20% down payment, it's generally a good idea to wait until you have more cash to offset the amount of money you have to borrow. 20% might sound like a lot, but it will save you money on interest and private mortgage insurance, and put you in a more secure financial footing as a homeowner. Plus, don't forget you need enough cash on hand to cover closing costs, which typically equals about 3% of the purchase price of said property. Number 3 is your debt to income or DTI ratio. Lenders look at your front end and back end DTI when deciding whether or not to work with you. To calculate your front end DTI, divide your projected monthly housing expenses, so your mortgage plus your taxes plus insurance, by your monthly gross income. For the back end, divide all of your monthly expenses, including your projected housing, loan and credit card payments, by your monthly gross income. Most lenders are looking for a front-end DTI below 28% and a back-end below 33%. If you're not there yet, you should wait until you're in a stronger financial position. Number 4 is your credit score. The higher your score, the better chances of you getting approved for a mortgage with a lower interest rate. Not to be dramatic, but even a single percentage point really matters. On a $400,000 mortgage, for example, the difference between a 4% and a 5% interest rate would cost you $68,000 over 30 years. It's worth doing whatever you can to boost your score before calling the mortgage broker, even if that means holding off longer on buying a home. Now the last one I want to talk about is investment accounts. Whether or not and when and how much you dip into your investments in order to have cash for a down payment, that's a personal call that depends on a number of different personal variables. Make a plan you feel good about and do whatever you want to do. That said, pulling from your retirement accounts for a down payment is basically a cry for help. Please don't make me come talk you down. Leave your retirement alone. Making a withdrawal means you'll likely face fees and taxes, not to mention removing a vital source of compound growth and diversification for your future income. Purchasing a house isn't a good idea if it requires you to put your retirement at risk. Now that we have that out of the way, let's talk about some pros and cons to both buying and renting a home, starting with the buying benefits. First one is that you may build equity and credit. Every year you hold your home, when you have a mortgage, you're gaining equity every single month, which is not actually possible while you're renting. You also don't have a landlord to answer to. You're the landlord. The next one is you're going to have more stability. While renting, you're sort of in a state of limbo. You don't know if the landlord will give you another shot at renting at the end of your lease, as they might want to sell it. You're also going to have possible tax benefits. Now, I'm definitely not a CPA, but there are many different tax benefits to owning a house rather than renting. I'm not going to talk about the specifics in this video, however I definitely will in a future video, so definitely be sure to subscribe so you can see that. And lastly, you can improve or upgrade your home to your own taste. Now, as for the cons, it starts with the fact that it requires substantial money and paperwork up front, most of the time. Most of the time, you're going to need to put down a down payment, which could mean quite a lot of money. Not to mention the fact it takes longer to get into the property and much more paperwork. You can also lose money if the home value declines. Just like any investment, it could possibly go down in value. And lastly, there are many more extra expenses beyond just mortgage payments. Unlike while renting, you're fully responsible for the property, meaning you have to pay for everything else. If the roof caves in, it's your responsibility to fix it, not anyone else's. You've got to account for repairs, capital expenditures, taxes, insurance, and other things as well. Now let's move on to the benefits of renting. The first one is that there's fewer upfront costs and paperwork. While renting, you won't need a sizable down payment and there will be much less paperwork. You're also going to have the freedom to be more mobile. If you know you enjoy the freedom of being able to move anywhere fairly quickly, renting might be better for you. You don't have to be tied down by having a lot of money in one property, as when you're renting, you don't have a property you really worry about. You're also not responsible for maintenance and repairs, you have no need to worry about falling home values, and there are also no property tax bills for you. And now, as for the cons. First one is that your landlord can raise the rent or sell the property. Whether or not your lease is renewed or if the property is sold is not up to you. This makes renting a bit more unpredictable than owning a home. You also don't build any equity. While renting, the money you spend monthly isn't coming back at you, unlike when you're paying down the loan balance while owning a property. You're also not going to have any tax benefits. Now I'm going to talk about this much more in depth in a future video, but when renting, you have no tax benefits. And lastly, property appreciation doesn't help you. When renting, the price of the home doesn't really affect you too much. When you own a home and the property price goes up just $10,000 for example, either by natural or forced appreciation, congratulations, you've just added $10,000 to your net worth. When renting, the benefit of constant property appreciation is not applied to you. And that's it. Thank you all so much for watching. I hope you enjoyed learning about whether or not you should rent or buy. Please be sure to like the video if you liked it. It does take quite a bit of time to make each video. And be sure to subscribe for 2 videos a week on both real estate and personal finance related content. Until next time, see ya.